All right. Hopefully, well, let me change that. Please try to come to the Ides of Monday type sessions and the other TRG sessions if you can at all while we're doing this class, because it saves me having to repeat stuff like today is rollover Monday, and it's by far the hardest and worst day of the year, the four of them a year to trade, and any experienced trader will tell you that. And it's easy to mistake luck for skill on a day like this. There's lots of momentum. I mean, you could be going with the momentum, but again, I showed at the opening session this morning. You can get absurdly off sides, and even if you're right, and it's just there's too much craziness to try to play it. So it's just a much better risk management to just sit this day out and just enjoy the show. I wouldn't even necessarily trade it in sim unless you're just joining momentum, because otherwise, again, you'll deceive yourself a little bit about what you're learning, I think. Anyway, having said that, let's get going on the class. So I thought this would be fun. Excuse me a second. I'm going to minimize that, and I'm going to minimize that. Okay, I thought it would be fun to start with and have a look at this. This is the presentation from the first chart to dome that we did what is now a long time ago. This is right at the beginning of Trading Research Group's founding, and JVC. The first thing he ever took of ours was this. So I thought it would be fun to go through this. Some of you were around TRG then, but most of you weren't. And there's some background in here that I think is really useful for this topic. And so let me just I'm just going to kind of scroll through the slides. I'm not going to do it as a presentation, but so this was March 14th, 2020 when we did this. So I had done a workshop on my own in 1999, and that's where I met Lee, and he was one of the students. And then we started TRG together in the beginning of 2020, and then this was the first full-blown boot camp that we did. And that's just a agenda thing. Okay. You know what? There's here. So there's a couple good things on here. Shorten the learning curve. This is what any of your education should be about. And as most of you know, I have a background as a professional trainer also for some big techs, IBM, Microsoft, and I also taught university and college classes. And there's a difference between learning theory and professional learning. And professional learning should always be about that. How can I shorten the learning curve? So I just wanted to emphasize that because that's what this whole class is going to be about. A lot of the stuff that I'm going to talk about in the next 2 weeks is stuff you guys may have seen before, but there's nuance to it that you will pick up by seeing it again. And so again, I'm going to try to come at these things from a couple of different angles for that objective, shorten the learning curve. Okay, again, if you don't know me, most of you do, but real fast, it helps to understand my background. I started doing trading in 1973. You can read for yourself. I had birthday money and mostly traded options, mostly on buyout candidates. That was like my big thing. I used to go to the library and research it. And, the greed is good days of, Wall Street, the first movie, when people were buying companies for the value of their assets, it was that time. So anyway, got started in futures actually right before 1990. It was 89, and I've done it ever since. This is old. I am almost 65 now. As I mentioned, I taught and was a technical sales trainer for many, many, many years. And I'm also a VC. I have invested in a bunch of different startups and have also been as a founder, principal advisor, whatever. Sometimes executive or a sales manager or a business development manager, depending on how old I was and what it was. Okay. The reason I put these pictures in for this presentation, and again, remember, this is, almost 5 years ago, was I was trying to make a point that no matter how much things change, they stay the same. And that's a phrase you hear over and over again. But in trading, again, it's really important to understand what we're doing. Trading, the purpose of trading is not to be right. It's not to be wrong. It's not to be exciting. The purpose of trading, it's a business for us. So we are here to execute taking money out of the market. That's why we're here. And if you look back in history, I've got hieroglyphics up here on the trading floor from years ago, and then one of my older platforms in the middle here. This was in 1999 to 2003 is that one. When I was trading options, I used to use this thing on the left, a quote track. That was a radio receiver that you could get quotes with. And you still had to call your broker to do trades. This was in the 80s. And it was ridiculously expensive, a couple $1,000s for the device and $500 a month subscription. And back then, that was a lot of money. And then, this is kind of what my setup looks like today. And this up here with the lake, that was when I lived in Colorado and Littleton. Beautiful place, by the way. So all these things are the same. The problem for folks that are new to trading, particularly if you're younger, and particularly if you have any sort of engineering background, is you're going to overthink what you're seeing. You're going to look at stuff, whether it's technical analysis or it's order flow, and you're going to forget that this is the same. Go back to hieroglyphics. Go to ancient cultures. Candlesticks charts are a really good example of this. Candlestick charts were developed in Japan like 400 years ago or something. I mean, if you've studied it, you know this, but as a way of capturing the movement of prices. And there's been, over the course of history, there's been lots of ways to do it. And that's why I have the hieroglyphics up there. That's one of the original ways, at least as far as we know. And symbols meant something. Well, it's the same here. Don't look at this like what we have with, our really sophisticated tools and overthink it. That's going to be the main message of this class. That the tools, if you heard what I said at IDES this morning or at the opening session, the tools are there to keep me from making mistakes. You'll see the patterns just in the numbers. And the more you look at them in the numbers, that's the dome part, the more you will see them. So up until that point, having a view of linearity, for lack of a better way to put it, can be helpful. So let's move on and let's see, this stuff doesn't matter. This was just kind of the next level. This is a picture of what a risk manager looks like in a real prop firm. And, showing examples of how you can watch so many markets at the same time, but it's all about the numbers. And so these are the assumptions we're making for this class. And again, if you remember all the assumptions and why we're here, then the purpose, which is shortening your learning curve, will more likely be successful. So here's the things we're going to assume throughout this whole class, whether you're new or you've been trading your whole life. Markets are auctions. Okay, they move up and down. There's no such thing as sideways. But if you're looking at technical analysis or any sort of chart, there is a sideways. And this is something you just have to learn to forget. It's up or down, and that's really significant. And one of the ways this is going to get a little cloudy is this, the concept of trend. They always tell you in technical analysis, the trend is your friend, all this nonsense. The bottom line is, in the futures markets, again, if you're thinking properly, if you're programming your brain properly, there can't be a trend if we're going up or down. There can only be the rate at we're going up or down, and if we're pausing at any significant spots. And guess what? Those are inflection points. Now, if you go back and look at technical analysis price levels, often they act as inflection points. To some extent, that's a self-fulfilling prophecy, because people know, big traders know that a lot of retail traders watch those, and a lot of big traders watch them too. So again, if you simplify your brain, which is what this is all about, shorten the learning curve, simplify your thinking. And I know many of you have struggled with this. I've coached a couple of you. I've seen conversations in the pit. We've talked during my live classes. Focus on this stuff. Number one, a market is an auction. It goes up or down. Don't ever think sideways. Instead, if we are at an inflection point, the market will go into ebb and flow. And ebb and flow isn't sideways. It just means the volume is balanced. Therefore, price isn't going to change significantly. And that's important because that's the concept of value. Okay, all charts are wrong. This is a really good point. It's Lee's favorite phrase, and I love it because it tells you what you really need to focus on from the point of people say, well, I trade the 5-minute chart. Well, whatever you're seeing on a 5-minute chart won't be there on a 1-minute chart or a 4-hour chart. And so basically you can data fit if you change your time frame. And so people look at multiple time frames. This is one of the big technical analysis things. And before order flow, it was all we had. So there was some contextual use for it, which was the next point on this presentation slide. So you have to learn to think that way. Any time frame that shows something, I could show you another time frame that wouldn't be significantly different in terms of time, but it wouldn't show the thing you're talking about, whether it's unfinished business or it's a price extreme or it's a big fat whole number. Anything you can look at, pivots, any of those things. So if you look at it instead, markets are auctions, they go up or down. Charts are useful for context. Again, simplify your thinking and shorten the learning curve. So all that matters is the auction, and we want to be really focused on the auction when it's at inflection points. And the problem people have seeing that on domes and vertically is they don't understand what this actually means in terms of auctions. So that's what these tools are so useful for. And so let's scoot on just a little bit, and then we'll actually talk about some of the tools. Okay, so here's a little summary. When we talk about the word order flow, what are we talking about? What you're thinking about that? What should it be? Again, markets don't go sideways. Forget linear thinking. Any metrics that are based on price, and I listed a bunch of them here, are always going to be wrong, and they're always going to be exploited. So the VWAP, for example, it's a really good measurement of approximate value. But one of the things we look at, and we've talked about this in TRG a lot, we look at the extremes away from the VWAP, and we never just automatically trade them. We look at them as potential inflection points where maybe we've gone far enough, because sooner or later markets tend to go back to value, but it happens when it happens. It doesn't automatically happen on a 5-minute chart or a 5-hour chart or a 5-day chart. It happens when it happens. So that's why watching the actual numbers is so much more important. And the tools tell you places where it might be worth looking. And that's that key distinction. So what's happening right now, especially if it's any sort of inflection point. And again, the definition of an inflection point is really simple. The market has a lot of momentum and then it suddenly stops. Guess what? You've got an inflection point. Or the market has a lot of momentum back and forth at a price that, let's say it's an ES is maybe 8 ticks back and forth, but there's lots of energy. Guess what? Inflection point. There's a battle there between the buyers and the sellers. So that's what you're looking for. What works? Okay. Think in terms of the flow of prices. And this is why wave volume is so useful, because it's so visual. If you, again, don't misinterpret it as being linear, instead just think of it as flow. So when it feels like it's at an extreme, it will start to struggle. And so that's a really good spot to compare the volume with how did it go at the other end of that range. And that's why a zigzag of volume and the ticks is so useful, because it tells you how much volume it took to get so far, whatever the number of ticks was. And again, I'm going to show you lots of examples of this, but these are the ways to get thinking that way. And then after a while, if you watch it over and over again, you start to see it on the dome. And that's why I always say that the purpose of the tool for me at this point is not to make a mistake, but it's also a really good way to learn how to do it, which is how I originally started with the tools. Okay, let's see. We're going to talk more about regression analysis. That's the linear regression part. Because again, we'll see the edges of the ranges. That's the inflection points. And if you can game that at all statistically, that's very helpful. And that's what linear regression does. It says, well, given the price for the X number of bars that you're regressing, what's the best fit of the data? Not the high, not the low. And that's why you can't just trade off that. What's the best fit? It's again, it's an interpretation, but it's using a statistical method. And that gives you another piece of your edge, another little piece of the puzzle of simplifying what you're thinking about. This last thing is really important. Improvise, adapt, overcome. Conditions change constantly. And this is the one thing that people, once they understand it, often screw up on. And a really good example of that is this week, because this only happens 4 times a year where we do rollover and then we do quad witch. And I can't tell you how many times I see on bulletin boards and Facebook and whatever, oh, I was trading great for 3 months and I blew up my account. Well, it's rollover. That's whatever you were doing well for 3 months is really unlikely to work well now because the data isn't accurate. It's like, remember, we're basing everything on the order flow, and the order flow is in 2 different instruments. And even just adding it together isn't correct because it's transitioning from one to the other. And you don't know who's on first and who's on, you don't know who's playing where. And so it's just really, really important to keep your head clear of that stuff and just focus on, okay, what am I seeing right now? And how is it changing if it is at all? Okay, a couple of books that are really good on this topic. And I like to review these again because we don't do boot camp format like this so much anymore. And this is a really good way of just kind of giving yourself a learning path. Stedelmeyer's Markets, that's the original market profile book. That's pretty far out of date now. It was done in the 70s and 80s, didn't have overnight trading. We've posted the workbook for it in the pit. You can see that if you're interested. These 2 books, Mind Over Markets and Markets in Profile, were the best interpretations of that, particularly once Globex and 24-hour trading started happening. The problem with these 2 books is Dalton can be a really, Lee doesn't like him because I think he is what he is. There's a lot of words you could describe him, but he's been an icon in market profile for a long time. And because of that, his viewpoint might be a little bit larger than it should be. Let's put it that way. So again, Markets in Profile particularly is a really good book for understanding how to implement this. Okay, Thinking in Bets by Annie Duke. If you haven't read that, you should read it today. That's the best book there is on terms of making decisions and trading because, again, breaks it down to thinking in terms of some sort of model and not using your emotions. The Art of Learning is a great book about a kid that was a chess master and became a Tai Chi master, and it's really interesting. Blink, you've probably heard of that. Again, it's about how your brain learns to make decisions faster than you can do mathematically, and the speed of light, it doesn't add up. So that's something becomes a blink when you've done it so many times that you don't think about it. Studies in Tape Reading is the original Wyckoff book, and it was written around the turn of the last century, not, I'm talking about 1900 to 2000, talking 1800s into the 1900s. That's what I'm talking about. So a long, long time ago. Trades About to Happen was a kind of interpretation of modern by David Weiss. Again, a great book and a great guy who passed away not too long ago. And so again, this is another, Moneyball is another statistics-oriented sports movie, but there's a theme here, and you probably see it. You have to learn to think statistically, and so some of these are the theory, and some of these are ways to implement that and teach yourself to learn. And anyway, I recommend all of these. I don't want to spend too much time on it, but it was, again, doing a boot camp style introduction for this particular class I thought would be cool, since a bunch of you haven't been around when we were doing boot camps. So anyway, we're almost done with this part. There's a little bit more I want to talk about. We talk a lot when we look at the VWAP and the SDs of the VWAP, have we gone far enough? And we also talk about it when we look at the volume profile and, have we created an extreme? Do we have excess? And basically the statistics, most of you, I think, already understand this, are based on just a simple model of a normal distribution curve. And so this and this are the same thing. But it's important, again, there's a distinction here you have to get married to. The one on the right is theory. The one on the left is real. Theory and real don't always add up. Why? Because people don't always follow theory. And there are tools to get people off sides on their theory, algorithms that do the gaming of 3 ticks. We see this stuff all the time. And so that can make, well, if I would always fade 3 standard deviations, why not? It's likely to go back. Yeah, unless they can push it further. And then I've seen it go to 6 standard deviations. So again, you can't just have absolute rules. And that's the trouble with trying to automate trading, is there's always going to be places where the tool is telling you everything it can, but the situation is unique enough that you really need to understand what it is. And one of the reasons I put this chart down here in was to show you can have a really aggressive move. And if you just look at the price history and the volume of that, look what happened here. This is like working up. This would have been a perfect long trade in the trending world, right? Right up until it wasn't. Something happened there. And then look how much damage that did that quickly. And this is the nature of auctions. When people stop bidding, they stop bidding, and the price can drop really precipitously. And they know that. So they will wait a beat before they start bidding again because they can get a better price. The linear regression side of this is simply, again, real simple. If you look at a bunch of data points, this was college scores for this example, and you say, well, what's the best fit of the data? You get a line, and then a regression channel is just the best fit going 1 or 2 standard deviations. I use 2 in either direction. So again, it's the same statistical model we were just looking at back here. We're trying to understand, if you get to 2 standard deviations, you basically should have about 96% of the data. So that should be pretty representative. So that's why you're looking at a channel that much on either side. And here's an example on one of my old NinjaTrader charts. You can see the linear regression channel there. That's basically the regression and then 2 standard deviations on either side of it. And I didn't plot the middle line because I want to know where is it extreme. And you can see it, you get a wick at extremes often because there's a lot of trading models that look at this very thing, because we're getting far enough away from value in either direction that there's going to be people trading back to value. So that brings up a really, really important point that I want to emphasize again. Market profile, remember I mentioned that this is all based back on Stettlemyre back here. Well, if you had to summarize market profile theory into a couple of sentences, this is what it is. And again, this is the kind of thing you should just have memorized and understand automatically. At some place there's value. The value should be roughly the middle to a standard deviation either way. And you see that all the time on my charts and on my domes. And that's roughly what I'm looking at. On the linear regression, again, I'm looking at 2 standard deviations from whatever the best fit. That's a slightly different way of looking at the same thing using a statistical model. And if you throw the wave volume on top of it, and that's what these numbers are, you can tell the relative difference of the energy, and that's why it's so powerful. For example, look at this thrust up to the edge of the range where there was a wick. The volume was 34K. And then it went down 23K. That's roughly even. Then it bounced up 22K. This is ebb and flow. We have found an area where buyers and sellers more or less agree. This is an inflection point. When you're going to leave an inflection point area, that's the direction you want to trade, whichever way it goes. Guess what? This broke down right there with an upthrust and then using Wyckoff terms, and then the bottom just fell out. So again, if you waited to anywhere in here to short this, even if you missed the first move, it was a really low risk place to play. But the technical analysis trader would have looked at that wick and bought that spot instead of considering the volume. Because again, 34 up, 23 down, 22 up, it didn't even register on the downside because it was past that point and bigger. And then when we finally did get a number all the way down here, 64,000. So this move was 3 times the size of that move. And that's why you always go with momentum. Now, is this a trend? No, it's not a trend at all. And that's the problem with the whole trend idea, the whole term trend. What matters is short-term direction and the amount of energy it has. Trends are looking backwards. And by definition, if you're joining a trend, you're always going to be offsides. You either have to wait for it to pull back, which is being offsides to the trend, it's a pullback, or you have to just join it blindly, which means you have to take the ask and you're offsides instantly. So again, get rid of the term trend. It's the wrong term. You want to be thinking in terms of energy and momentum. Okay, let's see. We did that one. Okay, that was just the schedule for the old class. And yeah, that was okay. So that's, I don't want to spend the whole class doing a slideshow. I just wanted to zip through that, give you a quick kind of what did a boot camp introduction look like. Oh, and the one thing I'm sorry, I forgot to the summary of market profile. I was just the book that was written in the 70s. And let me just break it down. This is what matters. I pulled this out and I didn't mention it. So price value is roughly the VWAP. And if you get a standard deviation either direction, you get roughly value. And again, we looked at that. That's like 66%. And if you go out a couple standard deviations, you get 90s. You get in the 90% and almost 99%. It never gets to 100%, but it gets closer and closer. So think about it this way. If we're above value, in other words, the VWAP, standard deviation one, either direction, you would expect above value that the market would find sellers. So you should be looking for that. You should be looking for absorption. You won't always get exactly right where it's going to do it, but that's what it should do up there. If it's not doing that, then what you're seeing in market profile terms is called initiating behavior. The former one is responsive. We get above value, you would expect sellers responding to the fact that they can get more than value. But if it gets a lot further than that, you're getting initiating behavior. The value's changing. And this is the key to how you understand changing conditions. And that's the number one thing that you guys struggle with is understanding that conditions have changed. And that's the way you do it. So at the other end, again, if it goes below value, you should expect to see initiative buying, above initiative selling. That's what it should be like. If it's not that, then that's what you should be questioning. And because again, these two things should go together and it should keep you on the right side of it, the correct side of it. Okay, so the rest of today's session is going to be about tools. And let me pause here first and see if anybody has any questions. If not, I'm going to take a real quick break and go get some water. And then we are going to go through each tool. And a tool, for example, I'm going to put everything away but the wave volume. And we're going to look at that and, okay, how do you use this tool? What's the purpose of this tool? So that's what we're going to go through. And again, a lot of this will be review, but try to listen from the point of view of how can I shorten my learning curve by understanding this as accurately and as simply as I can. That's the key. All right, I'll be right back. If you have any other questions, post them in the chat. I'm just going to go refill water. Be just a minute. Okay, I'm back. So let's talk about tools. And again, the idea here is going to be what's the shortest distance to learning more, being better? How can I shorten my learning curve? So a couple of things I've said already that I need to repeat. All time frames are wrong. We are looking at 30-second wave volume. That's going to show us certain patterns, like this beautiful little breakdown here to short, and a little bit of an overshoot of that for maybe a long down here where it's still kind of struggling. It's an ebb and flow at the low. That's always dangerous. But if I were to put this on a different time frame, it will look completely different. And this is a really important point. So just for fun, let's change 30 seconds to 300 seconds. In other words, 5 minutes. What does that look like? Give it a second. Got it. Okay. See, on a 5 minute, whoops, it's not scrolled properly. There we go. All right. See, on a 5 minute, I can't see any of that detail. I can see the aggression to the downside, but I might be misreading that aggression because this could be the spot it's turning. I don't know enough looking at this. And I'm only getting really big waves, which again are much harder to interpret. So choosing your time frame is kind of important, understanding that all time frames are wrong. So there's two things that I do with these tools. Number one is I make whatever I'm looking at with regression and whatever I'm looking at in the wave volume roughly the same time frame. And the reason I do that, again, remember, this is the statistical range and this is the energy within it. So let's go back and look at this again with that kind of warning in our back pocket. We are in ebb and flow at the low. So who's in control? Well, on the way down, obviously this was shorts in control, sellers. Now, I don't know. Let's see. That big move down kind of doesn't matter in terms of the volume, but it was 8K of volume. Okay. But that's over now, clearly. We bounced on just about 6K, a little bit less, 5K, 1K. What did that just tell you? And then 6K. So if I look at that, is there any pattern in those numbers that might be useful? We just had a big giant move down. We bounced how much? Let's see. We got down to 530 and we bounced back up about 70 points on a total of about, call it 8K of volume. And we just came down on 8K of volume. That's interesting. So that bounce just kind of could have been what? People taking profits on their short. What's happening now? Well, the volume's picking up again at the downside. We're back at that ledge. So again, this is a really good spot to be watching as an inflection point. But here's the problem with just wave volume by itself. We can't see what's happening right now in the auction. Whereas if we're watching the dome over here, we can see it really clearly. Or if you were watching on a footprint, but this is a footprint. So let's reset that and watch right there. Okay, we can see now who's winning the battle. Is this getting absorbed? Not really. There was some trading on the ask there, and we don't have any sort of excess down below 29. So this volume profile doesn't really look, it's really hard to game it either way. We're far enough away from the VWAP, you could get a nice bounce, which like we just saw, but can you conclude that that bounce is buyers taking over, initiating, or it's just shorts taking profits? You can't. We don't know enough yet. So what would the answer be? Again, what do the tools help me do? They keep me from making mistakes. They would keep me from playing that either way right now, just because of that. We have balanced volume at the low without any excess, and we're moving around a lot. So we don't have a dominant direction and we don't have dominant energy, although we did get almost to the edge of the range again, and that's why that statistical range is useful. But remember, again, if I make this 15 seconds, it's going to look different. So make sure you kind of keep your time frames standardized if you're comparing volume and the statistical range. That's just a good practice, best practices. And again, this area gets really interesting. Look down here, we had a bunch of wicks overshooting the best fit, but it clearly was where the buyers stepped in. And we kind of just revisited that spot. See, and we're bouncing again. See, I was just, this yellow line shows where we're at relatively. It just came down and touched that spot again. But look over here, there really aren't a lot of wicks there. It's kind of fat at the low. So that makes me think we might go lower, just from candlestick theory. But again, I want to watch the volume. So the last push down, and now we're bouncing. So this next bounce is really important, isn't it? If it can go out and maybe take out the previous one or show more volume, then that would show what? That the buyers are truly buying here and it's not just shorts covering. And that's not clear. Again, this is the beauty of doing this today, is you can see why rollover conditions are just so unclear, because you get a lot of movement that looks really significant and it turns out it might not be. For example, all this selling, somebody could have been rolling from another contract or arbitraging, and we saw the same amount of energy going up just slightly before that. If you add those up, that one actually was 22K right off the open. So that was much more energy than we went down with. And again, so we made another 8K dip there and we formed a wick a little bit higher, but not significantly. So again, I would read this as sit on my hands is kind of the theme we've been talking about all day. So the wave volume tool is you're comparing exactly what Chris said. You're trying to see which part of the short-term energy is more aggressive. Where's the volume? Because that tells you who's pushing that way, and you never want to fade that kind of energy. So you wouldn't want to be buying into a push down like that. But now that it might have a low, if you were looking for a long, this might be a place to do it, although it's risky. But you don't want to be the rookie trader that bought this bounce here. And so that's why understanding the conditions is so important. And remember, there's three types of conditions. There's price discovery, which is really high momentum in two directions, up and down. And that's just nearly impossible to trade. And it's what we get when we get economic numbers. Then there's high momentum in one direction. This is it. It's really clear when that's happening, particularly if you use wave volume. And also this is an equivolume chart, which is, the width of the bar represents more volume. So real simple way, and again, it's not technical analysis. This price doesn't matter. This price doesn't matter. That price doesn't matter. What matters is that was an inflection point. So we want to see the volume when we start to leave that area one way or the other, and we want to join this kind of energy. Then when that move clearly is over, we want to wait and see who's winning here. Well, nobody at the moment. Yeah, you could be scalping along at the low. If there was other reasons to do that, like it's the Globex ledge, or the order flow is really thick down there and there's absorption, that would be a legitimate reason. But we're not seeing that. That's what we were just looking at over here. It's not clear at all that the low is in. So guess what? That's a real quick, simple example of chart to dome. This is the chart. Here's the dome. The value of this is actually much more important. The dome information showing me, was there absorption down here? Yeah, there was 47 to 53, but then it got below that and there was a lot of selling, and that's a high volume node. So that's really dangerous. This is not a clean bottom at all so far. So again, the tool tells you where to look, but ultimately the dome is really where the answers are. And if you combine the two, it's really, really powerful when you're new, because the inflection points just light up. And then you can go over and you can say, okay, what's really going on right here? And that's often the time that I reset my volume profiles. So I'll do that, and I'll, when we're at a low or a high or on a high volume node like this. So right here, is this bounce continuing, or is this the top of it? Well, let's watch this for a minute. That was only 2K. Remember, we just went down on 8. So this could be a great short spot if that holds. So let's see the VWAP's still way up here, but we are seeing what could be where it's starting to struggle. And again, the time frame doesn't matter. This could be anything, but I'm seeing it now in the order flow. We're trading a lot on the ask. Okay, they just finally pushed above that spot, and that could have been a stops run. You could see it traded up into liquidity and immediately turned. That's what stop runs look like. So we clearly have an inflection point. Does anybody not see that? I mean, the question is, could you game this? Well, If you had other information saying, yeah, it's really a good time to be short, like the ticks minus 1,000 or something, yeah, maybe you could play that. But there's no doubt it's an inflection point. Again, and that's the beauty of inflection points. They always tell you where there's potential trades. And then you look at the rest of the data, and this isn't the top of the range. The volume is unclear. It's going up on less than half of that, but it's still going up. So maybe that fills out as it gets to the top. We don't know yet. We don't have enough information. So, and remember earlier we looked at the heat map for the NASDAQ, and this is pretty mixed. So discerning that there's a direction when it's that mixed, again, is really difficult. It's just a mistake. You want to really watch the momentum at extremes, and we don't have that here. So the power of the wave volume is to see who's in control. And there's some other lines on here, which I'll talk more about a little bit later. This is Jigsaw's wave volume, and this is actually a proprietary tool doing the fat stripe, and it's a very useful proprietary tool. I'll talk about it later. It's basically gaming the volume. And then this one here is just a super trend. So that's just the price direction. And I use that on a lot of my graphical images. That's what's coloring this is super trend. So, which is just basically, again, mathematically it's trending, but I don't pay that much attention to that. It's the pattern of it. So that's the wave volume tool. Let's look a little bit more at the LRCs right now, because see how, again, you could see where the energy really came down, and you got the wicks there. Remember, this is roughly the same time frame. This is in Sierra chart, and it's also supposed to be equivolume, but Sierra chart doesn't do equivolume as well. Like you can see relatively it's fatter there, and as we came down, but that's not nearly as clear as what this looks like. It's just they don't, you can set it to start bigger or smaller, but the relative amounts aren't relative enough is really the simple way to explain it. So again, now we're right at the top of the range. So this should be a really interesting spot. But can I tell what's happening other than the wicks? No, I can't. But if I jump over to my DOM, wow, we're right on big fat 0, it's a high volume node, and it almost got us back to the VWAP, and the volume was less than half of it was on the way down. So on any given day, this is actually a decent spot for a short. Today, maybe not because it's rollover, but could you short here? Yeah, you probably could, but then they're gonna squeeze the shorts again, which they're gonna keep doing. So this is why we keep saying don't trade on Monday of rollover. It's good setup that might work any other day. Will work flip of a coin today. You just don't know. Okay, so let's see. Can I review the meaning of the lines and arrows on the wave volume chart? I will. Again, some of this is proprietary to Jigsaw, and I've got examples of this like I showed you in the slideshow for Ninja, if you're a NinjaTrader user, and you can do it in Sierra chart. But what's important you can do on all of them is this right here. The volume, this is just basically a zigzag. In Sierra chart, it's a zigzag. And what it's looking at is the volume of the swing relative to how much movement. So the white number is the volume, the yellow number is ticks. So for example, this move up from here to here was 221 ticks, and 4K volume did that. So you're looking at the relative energy. So again, see how it kind of just 4K, 6K, 2K, 3K, 3K, it got into this ebb and flow. And then when it came down here, this is where the volume picked up. And this red line you're seeing is a Jigsaw proprietary tool. I'll explain that further on in class, but not if you're in Sierra or in Ninja or any other platform, you won't have that. That's basically gaming the direction based on the volume. That's what that tool does. This other line to the right of it, the skinnier line, that's just super trend. And I have that. That's in Sierra chart. It's in everywhere you can find super trend. That's what's coloring these bars. Is super trend. If you look at the studies, this is Sierra chart. See super trend stop. There's two of them, super trend and super trend stop. And it's a tool that uses some way of measuring how much moving backwards you're willing to take to consider it still going up. And again, I want to go into that, but we'll do that more next week. So hopefully that answers your question at least well enough for now. I want to go back to the use of the wave volume tool because it's being very telling. We still haven't pushed up more than 8K. We only went 6K, but we did manage to take out the other two levels. Again, this happens all the time. That's running stops. And invariably, you'll see it either continue really aggressively because now we're above there, or we'll drift back down into the ebb and flow. And that's the answer to whether conditions have changed or not. Right there is what happens now, not this move up or the fact that it ran stops here and here. Because look at the volume. The volume is now picking up to the downside a little bit. So this is a spot you really want to watch on the DOM. It's also a big fat hole number at 0, and it's a high volume node. All the things I tell you guys over and over again are the key things to be watching. So look at what's going on in here. There's a real battle. The liquidity, there's a big high volume node. So again, on any other day, this would be a really good spot to trade. Either way, you could, any inflection point can be a long or short. That's, again, you understand the nature of an auction. Sometimes one way is better than the other, and that's what you're looking for. And on any other day, I would be looking for shorts here. But I know, given rollover, that it's going to be really easy to run stops here and squeeze shorts. And for that reason, again, we don't trade on Monday of rollover because our normal methods of seeing what's going on are going to be misleading. Ultimately, they'll probably work, as I showed you guys at the IDEs and the open session, but you got to take too much risk to make it work. So that's the message there. Okay, let's see. Okay, cool. Thank you for the follow-up, Peter. So again, don't be afraid to ask questions, guys. And one of the things you can do if you're in Sierra Chart, you could certainly take your linear regression and put wave volume on it. I know a couple of you have done that. And then, you don't need to have them both. I like to look at them separately because sometimes I will use different time frames. If the market is really getting bursts of high momentum and then it's stopping very suddenly, the range will be off a little bit if you go further out. It will look really clear, but you'll get run over at the edges. At the same time, if you make that much faster, you won't have that problem because the direction will be much more dominant because it's a faster time frame. See, on this one, you can see that that was going to be a place where you were going to get stopped out because the range is going up. But I had to go to 5 seconds to see that. So again, all time frames are wrong. You just have to learn to read what's happening. And they're running stops here and it's getting sold into it. And then they're pushing it back down and taking profits. So this is a perfect inflection point. But because of the conditions, I wouldn't try to trade it. But understand, the nature of that. And, the time frame will make things look very different. And there's no real optimal time frame for all conditions. But there is a way to look at which time frame is ideal for the conditions you're in. And again, I always go as fast as I can go with the momentum, except under conditions like this where the ranges are really large. And what do I mean by that? Well, if you look at a TPO view, for example, we've had these ridiculous big moves that then stopped and didn't go anywhere. You've seen this over and over in both directions. Well, we're at the kind of pausing. We're trying to find a price level up here right now. And again, the problem with that on any other day, that's a perfect apex forming. What's the problem right now? It's rollover. And so this isn't taking into account the volume on both sides. And I back adjust. So it's going to be misleading. And again, if you're not hearing the central theme here, it just today is a really misleading day, even with the tools being really dialed in. But it's a good day to look at the tools and understand how they work and what they're telling us. And that's our purpose today. Okay, I see a question. Is Monday the most difficult day of rollover? Absolutely, no question about that. If you said to me, what is the one condition day that you would never trade, I would say rollover Monday. If you had to remove, because it's the Ides of Monday and it's rollover, it occurs 4 times a year and it's always a pain in the ass. And again, what I said at Ides, I've had days on rollover Monday where I made $50,000, but it might have just been luck. And when I go back and debrief it, it was luck. It could have gone against me just as easily on those days. So that's just, over the decades, it's one of the things you learn. Well, it's just not a good day to trade. And it's funny, Lee and I come from completely different trading backgrounds, but we both always say that, and not to be consistent. If we don't agree, you'll hear it. You've often heard it, but we totally agree on that, and all good traders do. Dimitri is one of our members from the very beginning, and he posted this on Twitter this morning. Again, it's anybody with any sort of experience will do that. They'll say this just isn't worth trading, and oh, let's see, where is Dimitri? There he is. And where was that? He posts a lot of stuff, but anyway, he posted, I was just trying to, there it is. Yeah. So anyway, and I responded to it on mine if you ever watch Twitter, but I don't want to get distracted into Twitter. Okay, let's see. I have a question. Are you able to share your jigsaw layout? Oh, absolutely. In fact, let's do this. Thank you for bringing that up. I meant to do that yesterday, and I had to go to the airport really late. A friend of mine came in late, and so I got distracted. I apologize. I was going to do that. Let's do it right now. I will make a new stream, which is going to be called Jigsaw. I'll make ones for the others as well, but this will be Jigsaw templates. And this will be my workspace from this class. And if you take that, that should have everything else in it. So let me go get that right now. You ask and you receive. And that way I don't forget to do it later also. Come on, Jeff. This isn't sorted alphabetically, no wonder. Okay. Jigsaw. There it is. Workspaces. This is the one I am using right there. Okay. Boom. Okay. Thank you for reminding me. Okay. Trouble remembering how to roll Jigsaw. Yeah, you got to do two things to roll Jigsaw. I'll show you. I already did it, but I'll show you. First thing you got to do is go and make sure you've downloaded all the current instruments, because the next contract might not be in the database yet. So you just, on your data connection, and you have to do it for each connection separately, you just click download instruments and CME, whatever markets you trade, and it will update them. So that's the first thing you have to do. Once you have done that, I also do something else. I get rid of the expired symbols at the same time, this clean expired symbols. That just keeps the database smaller, which is useful, particularly if you trade actively in a lot of different markets and instruments. Then all you have to do on any given DOM is just go to the search thing, and you just put in the base contract. Like this is NQ, and I'm on the Z right now, but the previous contract was not the Z. And so if you just put in the base, which is NQ, then you'll see, okay, there's September. That's the one we're rolling away from. And here's December. And you click on December, and then you're good to go. And then you can also, just look at the micros or any of the other stuff. So that's how you do it. Fairly easy. And you got to do it for every window. So if you have a chart window like this, you got to do it for that separately. And same thing, it's always the little magnifying glass. Okay, so that answered your question, I hope, Donna. Okay, so let's see, what time is it? 8. All right, I wanted to try to keep these to roughly an hour, maybe an hour and a half, depending. So we still have plenty of time. So again, I wanted to just briefly introduce tools. And so we talked about wave volume. What's on here? Excuse me, linear regression. This is regression. Again, best fit. The settings aren't important, but I've shared them a bunch of times. I use 2 different channels. They're both 2 standard deviations of 2 different amounts roughly of time, because it's based on bars. This one right now would be roughly 10 minutes. You can just see by the scale. And again, it's the amount of bars I want to see, not really any amount of time. So you can see, like, right now it's 8:24, and the back end of that is around 8:16, and this one is around 7:46, and so, but again, that changes. If I go down to 5 seconds, it's, much shorter amounts of time. So again, all time frames are wrong, and it's about capturing a good statistical view of the range. It's not about, having signals to trade off of. You're just trying to see what statistically is going on, and we're still going up. See, now we're above the VWAP. So again, what would you expect up here? Well, here's the open. You'd expect responsive selling. We sold off pretty aggressively. So again, in a normal market, you'd be looking for shorts up here. Is that good today? Probably not. Again, but we're going to be doing this every day for 2 weeks. So we're going to see a lot better examples. But again, you could play here. Remember, you also could have played at the VWAP and down at 0.0. And at the moment, those guys are heavily run over. And that's, again, welcome to, guess what? Rollover Monday. I like trading some of the infrequent days of the year, like quad witchings. I like to trade quad witchings, and there's only 4 of those too. But the reason I like to trade them is because they're very momentum driven, and that's my style. And that's exactly the reason that I rarely trade Rollover Monday, because momentum starts and stops for no reason, and it's really hard to read. And again, because there's money moving between the instruments really aggressively. So you might find over time that you'll find other conditions that you just don't want to trade. There's a reason we call it the Ides of Monday. I used to have really bad Mondays, and looking back over a couple of decades of trading and debriefing it doesn't make sense to trade Mondays. And then as I got more experience, I realized what I'd been doing wrong on Mondays, and that's why I went to the idea of Ides of Monday. Is that, it's not that I won't trade on Monday, but I understand that I used to make a lot of mistakes on Mondays for a couple of reasons. So if I think I can mitigate those reasons, I'll trade. One of them is I'm out of sync because I haven't traded for 2 days. And the other one, the weekend. And then the other one is often Monday price discovery is very misleading because it's, pricing in the weekend into the equities and the futures. So those are some good background pieces. Let's see. Can you trade micros using the minis? Oh, yeah, that's what I'm doing right here. See, it says this is MNQ, but the data is NQ. So if I traded this, that's exactly what it would do. You can see here. Well, and I'll put one on so let's put these on the same account. And so this is the data from NQ, but the micros, and this is the data from NQ, but the micros. So you'll see, for example, let's say I threw a short on here. You can see where it is relatively in crunched NQ and tick by tick. And this trade is a micro, but I'm seeing the mini data, and I could, see my profitability here. And then I can also see, since this is crunched, maybe where there's some inflection points. This actually isn't a bad spot to do this. It could go a lot higher up, but we could probably scalp this. Again, you just have to be prepared to get really far off sides if you're going to do trades like this. They probably will ultimately work, but there we go. Now, boom, big. See, they do that. They just flush the toilet like that, and it instantly becomes profitable. And but I had to scale pretty good to get it to do it. Right now, I can protect it. But this is really tricky stuff I'm doing right now. But I just made $75 doing it, and I still have a TLOT, can protect that. And boom, we get hit. See, so I wouldn't recommend that style to anybody that's new, but the information we're getting is perfect right now. We're right on an inflection point. We ran stops and totally got absorbed up there in the high 30s, and then we came right back to this spot. Look at the range tool now. Let's get rid of these. What's the range tool telling us? It's perfect. It's saying, okay, we pushed up in here, and now we're in ebb and flow in the short term with a wick on either side. So this is an apex. Again, on any other day, I would be looking for a trade here. It's definitely an inflection point, but inflection points are getting ripped both ways. But that's what you're looking for, where it pushes out of the range, and then the wick means that it ran out of gas. The body is where the most of the volume was. If you don't know how to read a candlestick, that's how they work. So wicks mean extremes. So in the very short term, we found a really clear extreme that is statistically the exact range. And that's a coincidence, but it's useful information. And we can also see this could go up to here and not exceed the range, and that's almost 60, or it could pull back to 85, 90 and still be a legitimate range. And then if you go faster, again, that's going to really change. The range is going to be much smaller and more specific. And now we can see why this is a short on the other time frame, because it has in fact started to turn down. Now the coloring of this bar is being done by that super trend indicator. So that's how this bar gets colored on if you're using Sierra. And I've already shared this in Sierra Chart. I can copy it to our stream, but it's in the PID and TRG templates, my Sierra Chart chart books. Okay, so let's see. Okay, so we answered that question. So again, this class is about what can we see in visual pattern tools, not order flow tools. I don't want to teach you how to read a footprint like this. This is a 30-minute footprint with a price rejector at the bottom, and we're at the bottom of the overnight low. That structure, this class isn't about that. If you learn that stuff, or if you already know that stuff, that's a great way to look at the market, but don't do that and this. Do this tabula rasa, do this blank slate. Watch the statistical range, look for inflection points. When you get an inflection point, then jump in and look at the order flow of that spot. Is this a spot I want to be selling or buying? It looks like a short, but let's see. Let's look at the wave volume. Again, these are quick visual tools. We got up above all those old highs on 4K after a weak push up, 6 versus 7 on this time frame, and a weak pullback. We're forming another apex. So again, this is really unclear, and we're right on the VWAP. So basically, we have value. It would be very hard to game going either way here. It could easily go up to SD 1 or 2 to the upside, or the top of the value area, or the open. Those are all roughly the same spot. Or it could go the other direction and do the same thing at the low, which, by the way, isn't very clean. It's better than it was, but it's still not very clean. So again, the tools are there to keep you from making trades otherwise that might look good. And that's a really good kind of mentality. I also want to bring this back up because this is the what we were looking at the open with the gaps. These are the rollover gaps. NQ filled most of it. ES has gotten a bit into it. Same thing, YM actually is weak now. It opened really strong, if you recall. And RTY opened really strong and then got sold really hard and then bounced almost to the high again and then got sold really hard. I think this is classic rollover Monday. So, if you can read a pattern in this that you think is tradable, good for you. But it's probably not there. It's probably random. But again, we're going to have 9 more sessions, and you're going to see a lot of examples where it's not random at all. It's really clear. We're demonstrating today as an example of days that you should probably not trade, or at least be very picky and size disciplined. Okay, that's really all the material I wanted to go through today. There's other tools on my screen that we'll talk about along the way, like the ticks and whatnot, but I talk about those all the time, and they're really not that much of chart to dome. Chart to dome is really about wave volume, the statistical range, and then when you see clear inflection points there, jump your eye over to the really short-term order flow, like on a dome, not a footprint, but that is a footprint there. It's just a really quick one. I just reset it to 0, and now we're seeing a brand new footprint. You could do that on a regular, on your Sierra Chart footprints. You're just gonna have to change timeframes a lot to do that, and that's okay. So if you're running your dome off of a Sierra, here I have like 1 minute. I'd set it on seconds and move around within that and use crunched NQ, which is what this is, which is currently on 1 minute. And you can see this is almost random on a 1 minute, but let's see, make it 5 real fast. And it probably looks more orderly as a long and short on a 5-minute view. So let's see. Got to crunch it back together. Yeah, it looks much more orderly. There's a stops run right there, which we just saw. There's a stops run down there, which we saw. There's a stops run up here. Yeah, this is, if you go out to 5 minutes on the real extremes, you can see the stops runs at both edges. And that doesn't mean you could necessarily trade them, but you can really see that is in fact the condition that we're seeing. This should be crunched, and it is. Oh wait, no, yeah. Oh well, we can. This one isn't crunched. This is tick by tick, but you can also look at that crunched, and it'll give you a little bit more range perspective, like you're seeing on my domes where I use crunched and uncrunched, and that's why I do that. By the way, that's probably the last really important point of tools. If you're going to watch NQ, whether it's MNQ or NQ data, it doesn't matter. Watching the compressed view like this is 4-to-1, so it's just point by point. It's fairly clear where the volume is. The high volume nodes are really clear. If you try to do that on tick by tick, which is what this is, it becomes really hard to read. So let me show you. I'll make this one tick by tick. You see, I've got it tick multiplier crunched 4-to-1. So 0.4 ticks, which is the point. Now let's look at it ones. And watch how the volume spreads out almost to be unrecognizable. We can still see where the VWAP is, but I mean, you can't see the high volume nodes even because they're spread out over so many prices that, all right, down there we can kind of see that one, but kind of see that one. But again, it's so long. It's like, well, where are the extreme? You can't see the information you need to see. So that's why having whatever platform you're on, having MNQ or NQ and a crunch view will give you really good perspective. You don't want to trade off of that because it's not granular enough. 4 ticks is way too much. That could cost you money in an NQ or MNQ trade. So if you do it tick by tick, you can see where to put entries and exits and then kind of see it summarized over here. So let me show you that real quick. I'll show you some examples of that. And so let's say I can see, well, here's the top of the range up here. So there's a couple of short orders up there. Let's say I wanted to sell that. Well, I got to scroll, those are up there and see how, and they're further apart. So when it gets to that spot to manage the trades, I'm going to want to see it tick by tick. On the other hand, now we're going down. So let's see if we can find a downside inflection point. It got bought right here. So where's 0, 0? 0, 0 is right there. So see, we might be able to trade it. And there's some liquidity parked down around 0. Again, this is just, could probably try to do right there too. That's the top of the high volume node. Let's see if that fills. Okay, so I got a little long on here at 5, and you can see this doesn't tell me what's really happening, whereas in here I can actually see the battle and I can perhaps protect that trade like that. And over here, that would be really hard to do. And here, it's helping me make a lot more money out of that. So that's why, and that's particularly true when you're in the mini instead of the micro, because obviously things happen in much bigger chunks, 10 to 1. Okay, so again, good questions, and I think this is a good overview for today of the tools. We're coming up on about an hour and 40. So excuse me, an hour and 1 at 10. Yeah, we started 7:30. So I don't want to make these too long. I want to just make sure I cover all the tools. Liquidity is an important part of the tool, but today the liquidity is a mess. So I don't want to try to give you examples of liquidity when it's in Rollover Monday, because what I'm trying to show you won't be easy to see. So that's the one thing on these displays. Oh, that's the other thing I wanted to do, is just go through what is on each of these domes. Let me reset the domes completely, and then I will tell you what every column is. So I just wiped them out completely. So the far right is always the volume profile, which always has the value area and the VWAP on it. And sometimes I'll put a range, like this has the 15-minute range in yellow. The columns on either side immediately of the price, in all cases, that's liquidity. So like right here, you can see there's liquidity again immediately, and then the one just to the outside of that I'm highlighting in yellow, that's the change in the liquidity, often referred to as stacking and pulling. So that's very important. But again, today I can't really show you good examples of that because it's Monday rollover, but we will look at that a lot. So liquidity, change in liquidity. This is the traded volume on the volume profile. And then this is 2 different ways of looking at the traded volume between those. One of them is the very short-term traded volume. That's the one that I just reset. And that will reset the numbers every time it trades back to a price. So it will show you if there's large buying and selling at any given price. And this one over here is just building me a new footprint, showing whether it traded on the bid or the ask. And then this is just summarizing the delta. So it's the net of the bid and the ask is what this is over here to the left of the price. And then if I have a trade on, it'll show up in the column to the left of that. And all the domes are the same. So for example, I don't know, let's see. What would we do here? Let's go long. You'll see I have a P&L, and so that's $25. Anyway, all right. So that's the tools. Are there any questions about anything? Just basically, this is about what are we seeing on my screen and how does it work? What's its purpose? Again, to shorten the learning curve. The rest of this entire class is going to be examples of that specifically. So obviously we'll be reviewing this literally every day, but I want to make sure the basic fundamentals of why we're looking at any given thing are clear. Okay, so if you have questions, put them in the text chat. Otherwise, again, intention is a good overview. I think we've got that. I don't want to beat it to death. Tomorrow's session, let me go back to the schedule for a minute. That will be useful. Let's talk about the schedule. That's what we'll wrap up on. That's a good thing. I meant to do that earlier also. So I'm reminding myself, okay, here's our schedule. So we just did this one, the explanation of the screen and tools. And basically I just have on my screen NQ, MNQ, and ES and MES and the wave volumes and regression for those. And then the stuff in the middle is, everything else, the equities and, what the heat map looks like and if there's any news coming up. And I'll mention that stuff, but, that's always there. That's not really part of the class. So tomorrow we're going to do the normal TRG open, which will end about 7 o'clock my time. And then a half hour later is when the initial balance forms. The first hour is the initial balance. And tomorrow should be interesting because rollover Monday should pretty much be cleared up by the initial balance tomorrow. We should have a decent defined range. And then the big thing is going to be all these interest rates decisions that are coming up. So it should be a really interesting session to look at some examples around the initial balance. And then Wednesday, we'll do the same thing, but we'll do it for the RTH close. Thursday is going to be really important because mid-session, particularly since that's the day before rollover, it ought to be the quietest day. We'll have had FOMC already. Remember, Wednesday is FOMC, so the close is going to be bananas. And then before the open, I thought we would do one of those in the first week because some of you are European times and whatnot. And so there are some interesting things that happen. And also don't forget, we have some earnings at the end of this week, a couple of them. We talked about that in the IDEs, and that could make that day interesting as well. After the close stuff here, so that could make the pre-market on Friday interesting, FedEx and Lennar specifically. So, okay, so that's our plan for the week. And then next week, we're going to kind of, I'll put up the schedule before next week starts, but we're going to, based on how this week goes, we're going to decide what we want to do more of, what times of the day, and whatnot. So that's the plan for the rest of the class. We're at the bottom of the range again. This is interesting. Now we have good downside energy again, but the volume is still relatively even in both directions. Remember, I just played what did I do? I did a long scalp over there in ES and I did a short in NQ. And, again, any inflection point, you can trade both ways. There's a direction that's usually easier. One direction is usually easier than the other. And if it's not, then it's often price discovery. So that's an important tip too. And I'm going to try to give you guys as much as I can. Okay, let's see. We talked about that. Yeah, we answered the micro, mini, and jigsaw question. All right, let's go ahead and wrap up here. And once again, let me ask for any final questions, burning desires. Otherwise, I will see you guys again tomorrow. We're doing the normal TRG opening session, and then that will end around the top of the hour. And then this class will start at the bottom of the hour, and we'll go through the initial balance and some of the shenanigans after that. It could get interesting, actually. That's the first day I would really take any significant risk and look for trades of this week is tomorrow. And then after the FOMC announcement on Wednesday, that'll be crazy. We're do the close, as I said. So it could be interesting. We could have some stuff this week, but again, if you're not feeling it, when in doubt, sit it out. That's a really good kind of thing to remember too. The good trade setups, once you understand the kind of visuals of the tools, they'll be really obvious when you have a good setup. It'll just bark at you that it's a good setup. And if you're seeing it's like, well, maybe it's a good setup, but maybe it's not, that's when you should maybe sit on your hands. Okay, thank you, Peter. I appreciate it. I'll see all you guys in the morning. Have a good rest of your rollover Monday. I'd avoid trading. See you later. The recording will be posted as soon as JVC can get it up, so to speak. See you later.